Refinancing isn't about timing the market. It's about taking control of your finances. Whether it's lowering your monthly payment, getting rid of mortgage insurance, or using your home's equity to reach new goals, refinancing can be a powerful tool to move you forward. In this episode, we're going to talk about how to know when refinancing makes sense for you, not the market. Welcome to the Locked In Mortgage Podcast, where we help you get your mortgage locked in. So hey, Nate, welcome back to the show. How you doing?
Doing good. How are you?
Good. I'm super excited about this topic because refinancing is obviously a hot topic, but I think a lot of people go about it the wrong way. They try to time the market.
Yeah, absolutely. We have a lot of people calling in with some questions, so it's definitely timely.
Yeah, it is. Good. What kind of questions do you have for me today?
Well, the first one I'm seeing a lot is that a lot of people are chasing the rates. And so why do you think so many people in regards to refinancing are so rate conscious?
Well, everyone's been taught it's about the rate, it's about the rate. And they're not wrong because the rate is your cost of money. Mm-hmm. And so most people that do rate and term refinances, they're purely trying to get a better rate, to have, a lower rate on their mortgage, to have a lower payment, to have more cash flow and all these things. But I think they go about it a little bit wrong because they try to time the market. And I think about that one old Wall Street saying that pigs get fat and hogs get slaughtered, mm-hmm. right? So in this, that so many people are trying to time the rate and they're trying to get a lower rate and they might not ever actually get to the rate and they're going to miss out on their opportunity.
Yeah. So if it's all about timing, or if people are trying to time the market, what is refinancing really about if it's not about timing?
It's about making sure you get set up right for your specific financial situation, right? There's lots of different reasons to do a refinance, and I can go into countless reasons. But the reality is that if it's all about the lowest rate, you might actually miss that and never get to the rate. No one ever knows what's going to happen next in the market, right? Mm-hmm. And so many people say the rates are going to keep going down. They could, but they might not also. So if you see an opportunity that makes sense for you, that's when it's probably best to move, not when you wait for a rate that may never happen. I've heard people say, well, I'm not going to refinance till rates get into threes. And I'm like, they're going to miss out. They're in the sevens right now. Mm-hmm. There are sixes. They're going to miss out on fives, lower sixes and even fives to better their position and for their long-term financial goals.
Yeah. You talk about bettering their position. How can a refinance really help someone improve their position?
Okay, there's a couple different ways. And I mean, that's a very broad question, right? So there's a couple different ways. There's called a rate and term refinance, which is basically just that. They're just getting a better rate for their loan. They're not taking any cash out. Mm-hmm. They're not changing their term necessarily. They're not going from a 30-year to a 15-year. So just by bettering your rate, you can be in a better position. You can, improve your monthly cash flow, right? Your actual payment might be lower. That's what a lot of people initially think about when they think about a refinance is lower my payment. Mm-hmm. But now if they took that difference in payment and paid down principal, they might pay off their loan faster if that's their goal, to pay off their loan faster. So they could, even with a rate and term, you can either lower your payment and with that difference, pay down your loan faster to better your total overall position. Now, if we're talking about a cash out refinance, if they're using that cash out to do things like go on trips or spend money versus better their financial situation, like maybe they could use it to pay off debt and then improve their overall cash flow. Maybe they could use it to fix up their house before they sell it. How are you using the money on a cash out? Because that could greatly benefit their specific position financially.
Yeah. Absolutely. Have you ever, reminds me of a story, have you ever seen someone use their house kind of as a piggy bank and they've come to you multiple times? And
yes, I've seen that a couple times. And what happens is they will push their debt. They'll use a cash out refinance to pay off money they've already spent. And then eventually they run out of money in that piggy bank, mm-hmm. right? And so now they have debt. They haven't changed their spending habits. They've just tapped out their house, which I don't think is the best use. I mean, I understand if you get yourself in a situation, well, then you bail yourself out with an equity line or a cash out refinance, but then you've got to change the habits so you don't get in that position again. And that's the mistake I see people make is they use it to bail themselves out, the equity in their home, but then they don't change the habits that caused that problem in the first place.
Mm-hmm. And then on the flip side, you've seen scenarios where, they do the cash out refinance and they cut up the credit cards and do everything. And that's kind of what the whole goal is on that.
Yeah, we've all made mistakes before. We've all gotten ourselves, most of us have gotten themselves in a financial financial position, whether it's because of you had a lower income for a little bit of time, or you had a specific event, like maybe a medical or even kid going to college that you weren't properly prepared for. And then it's time to right that so-called wrong, right, that we didn't plan for appropriately. And then we used our equity in our home. But if you don't change the habits, if it's about debt and paying off debt, and if you don't change those habits, it's just going to happen again, and you might not be able to get yourself out of that situation.
Yeah, absolutely. And so what are some signs that refinancing makes sense for a homeowner?
If it depends on your goals. You have to think about your goals. How long am I going to be in this home? Am I looking to do I have an acute issue with cash flow? In other words, my bills are greater than my income.
Mm-hmm.
My expenses are greater than my income, and I have an acute issue that I've got to fix? Or do I want to get out, do I want to pay that house off sooner? Do I want to be able to retire in 10 or 15 years and not have a mortgage payment? So you really got to look at what your specific goals are, and you have to have that in mind. And then with that, does this refinance help you get to those goals in the time period allotted? So it makes sense for the people that understand their goals. And if you don't understand your goals, that's okay too. But then it's time to put pen to paper and say, what am I trying to accomplish? And what are the tools that I have to get there? And a refinance is one of those tools. If you have an acute shortage, right, between what your monthly outflows are and what your income is, you need to improve your cash flow. Now, some people say, well, that refinance isn't going to get me there. But maybe a cash out refinance would. Maybe you have some debts that could be paid off with a cash out refinance. And here's the thing to understand. You're going to possibly extend the life of that loan, because you're going from whatever you have left to another 30-year loan. You're going to probably pay more in interest than you would have if you just paid off those. Like a car loan is at 5-6%, right? Well, mortgages might be at 5-6%, but they're spread or amortized over 30 years. So if you throw a car into there, you might end up paying more for that car. You will end up paying more for that car over time. But if it fills that shortfall, that acute issue of expenses versus income, it might make sense for you in the short term to do that. Now, I would tell people to be careful with that, because now you're gonna pay more for that car, and it might actually, if you go out and buy another car, you're just going to exacerbate the issue.
Yeah, absolutely. And one thing that we haven't spoken about yet is mortgage insurance.
Right.
How can removing mortgage insurance, or even shortening the term, really make a difference over time?
Well, mortgage insurance, it allowed you to buy that home with less than 20% down. If you're doing a conventional loan or an FHA loan, I think you always have to have mortgage insurance for a certain period of time. Or forever with certain loans on FHA. VAs don't have mortgage insurance. USDA doesn't have mortgage insurance, a monthly payment. But if your house has increased in value and you're paying mortgage insurance, you can actually ask them to take it off after a certain amount. But if you haven't reached that amount naturally, like by your natural amortization schedule, the normal payments you're making, and you want to get out of your mortgage insurance, you could actually refinance the house if it's worth more and get out of that. That's one way to get out of your mortgage insurance. And that will reduce your monthly payment, which obviously increases your cash flow. You can put that back into paying down the equity in the home. You can do, you pay off other expenses with it. So it has an added benefit. But the point is, you got to look at the whole financial picture.
Yeah, absolutely. So what do you think is the most common mistake people make with refinancing?
They don't look at, does it make sense now? They chase a rate. Okay. So there's lots of different kinds of refinances, but you have cash out and a rate and term. Rate and term is just refinancing the loan into a lower rate, or a different term, going from a 30-year to a 15-year, or a 15-year to a 30-year. A cash out is getting equity out of your house in order to do either pay off bills, there's a lot of different reasons you can do a cash out. But so the mistake I see people make is, one, if they did cash out for debt reasons, that they don't change the habits that got them there in the first place. Mm-hmm. The second mistake I see people doing is waiting or chasing a rate that may or may not ever happen. Like we had people we talked to a couple of years ago, so the markets never go up or down exactly. They'll trend downward, they'll trend upward, but you'll see pockets of low and high rates over time. And so when the rates might get into a realm that makes sense for a refinance, people say, well, I'm going to wait till they go lower. Right? That's like holding on to a stock after it's already gone down, saying, I think it's going to go back up. It may never go back up. Your rates may never go back down. And so I saw that happen. There's an opportunity for a client to refinance 3 years ago. They didn't take it because they were waiting for a lower rate. Here we are 3 years later, and we still haven't seen that lower rate. Meanwhile, they could have enjoyed the lower payment for the last 3 years. So even though I do believe rates are going to go down, there is no guarantee that they're going to go down. There could be an event that happens tomorrow or the next day that makes it a refinance, makes the rates go up, right? So while all the talking heads and all the world says rates are going down, while that could happen, the opposite could happen as well. So if you see the mistake I see people doing is if it makes sense for them and they don't pull the trigger because they're waiting for something better, right? That's a major mistake.
Yeah, you never know what's going to come up. We were talking about COVID, and no one had that predicted on their bingo card per se. So
nope.
So something like that could happen, and like you said, it could make rates go up in that random scenario. So,
Good. Yep.
What are some times? Can you tell me about a time that someone called you asking for a refinance and you said no? Or, you said it wasn't the right time for them.
That's tough because legally I can't deny someone an application. So I can tell someone, hey, this doesn't make sense, but I can't say no if it doesn't, because it makes sense to them, right? So I've seen people refinance for the wrong reasons. If there's some people that are told you just refinance that loan down the road. I would never promise someone to get out of a specific loan. Hey, take this loan and then we'll just get you out through a refinance in a couple of years, because you never know. You can't make that promise. You can't make that promise because you don't know if they're going to qualify at that time. You don't know if rates are going to be lower. You don't know if that program's going to exist. You just can't tell people, hey, we'll just do this loan now and refinance later. And I kind of forgot why I went into that.
Well, kind of to double click on it, what scenario would it not make sense for someone?
Not make sense to refinance?
Mm-hmm.
Like if the cost, I look at a cost versus the benefit, right? So I look at the cost to do the refinance and what benefit you get out of it. And some of these make sense legally. Like I could do the loan, but people look at the rate. And let's just make up numbers. These are not today's rates. This is not a promise to lend or any of that disclosure stuff. But let's just say rates are 6%. And someone's offering you a 5.5%. They're like, man, I'm going to get this 5.5%. I'm going to get a lower payment. It's going to be great. But if the cost to get that 5.5% is, 4 points, if I have to pay 4% of the loan amount to get that in points alone, it's probably not going to make sense if the market rate's 6%, right? So that discount, the discount points to pay that rate probably doesn't make sense, and they may never recoup that cost for if they're only going to be in the house for a couple of years. Here's where I've told someone this doesn't make sense. I'll do it for you, but it really doesn't make sense. Is if they know they're going to leave or sell the property within a certain amount of time, and if they're not going to be in the property long term, their cash flow might better their position, but when they go to sell that house, they're going to owe more on that house because most times, unless they want to pay out of pocket, but then they just negated all their the cash flow incentive by paying money out of pocket, right? So if they're going to be in the house short term and the recoupment doesn't happen, and the recoupment's when you've paid back that cost because of the lower payment, let's say the recoupment's you save $100 a month and it costs $1,000. Well, it's going to take me 10 months to recover that cost, right? That's simple math. Those are pretty low numbers, but let's say that 10 months, and if you're going to be in the house for 12 months, it made sense. If you're going to be in the house for 9 months, it didn't make sense. So that cost benefit analysis really isn't there. So if the cost benefit isn't there, not only will the VA not let you do it if you can't recoup within 36 months, the VA won't let you do it on an IRRRL. But it doesn't make sense to do, period. And if that recoupment cost takes 7 years, 8 years, statistics tell me that you're going to own that house or that loan for 7 to 10 years. So that's probably too long on the recoupment as well. Does that make sense?
Yeah. So is there a general rule of thumb that you kind of abide by, or is it just kind of every situation is a little bit different?
If someone tells me I'm going to live in that house forever, I'm going to die in it, you're going to have to drag me out of there in a bag or a box, right? Which doesn't happen so much anymore. 3 to 5 years might make sense on a recoupment. If it's less than that, or if it's more than that, you really have to question, is this right for me? Does it make sense? And so you have to look at all the costs versus the benefit it's giving you in the form of a lower payment. And if you're doing a cash out, you can still use this method because there is a cost to doing a cash out. And even if the rate's higher than your current rate on a cash out, what is being paid off? What's that monthly cash flow improvement look like as well over the short term and over the long term? And does that make sense for you as well?
Yeah, absolutely. So how do you kind of help clients figure out whether refinancing will actually help them towards their goals? Like, what kind of conversations are you having with
Well,
them?
first you have to understand their goals. Are you going to be in this house long term? How long do you see yourself in the home is the question I used to ask as a loan officer. How long do you see yourself in this home? And a lot of people can't answer, like, I have no idea, And some people will tell you, this is our 3 to 5 year home, and or I'm going to be here until my kid go to college, which is in 12 years from now. Some people can give you a very specific answer, but some people don't know, and that's fine. Well, okay, then it's the next question. After you figure out how long you're going to be in this home, then it's, what are your financial goals? Do you want to pay off faster, or do you want more flexibility in your cash flow or your monthly payment? And then you start to go down this funnel of questioning that's going to kind of give you an idea of their financial picture, because the reality is the majority of people who buy houses don't have a plan financially. Most of them do not have a financial plan. They don't teach it in schools. They don't teach it in colleges. You have to pay someone, a financial planner, to help you figure this out. But most people don't know what their financial goals are. So it's kind of like we kind of see ourselves as this person that's going to help them try to figure that out for the most part. And if you can help them realize their goals, then you can help answer those questions and figure out, are they looking for a short-term recoupment? Is it long-term? Is it cash flow? Is it pay down? Are they going to do a 15-year or a 30-year? Things like that.
Yeah. So for someone that's listening who's unsure where to start or doesn't know what their financial goals look like, what's the easiest way for them to find out if a refinance can benefit them?
First, again, understanding, look, am I trying to pay this house off faster, or am I just looking to improve my cash flow? That's probably the first one you want to ask yourself, because then it's going to take you down the track of, well, if I'm going to pay down the house faster, I should be looking at 15-year loans. Can I afford a 15-year loan versus a 30? You're going to pay a heck of a lot less interest at a lower interest rate on a 15 than you would on a 30-year. Okay, so most people kind of tend to go to the 30 because they like that next question, which is cash flow. They like the flexibility because you can always pay a 30-year off like it's a 15-year. You're just not going to have that slightly better interest rate to do so. But it gives you that flexibility to make a 30-year payment, amortization payment, or a 15 or a 10-year, or pay it off faster, right? And then it's so you obviously always want your lowest rate of money, but you don't necessarily want that at the cost of not doing it. So if the loan in front of you makes sense to your goals, am I trying to pay it off faster? Am I trying to get better cash flow in the financial picture? And you don't need to wait for the market to tell you to do that. If the rates look good where you're at, if the payment looks good in your financial goals and what you want to accomplish, and that's when you have to, no loan officer can tell you this makes sense. Because at the end of the day, it's going to have to make sense to you, not them. And so if it makes sense to you and the payment makes sense and the goals that you have, that's going to get you closer to your goals, then that's when I would say pull the trigger. Don't wait for a certain rate. Don't wait for the market to move if it makes sense now, because you don't know what the future holds.
Yeah. One little bonus question that I had was you talked a little bit about the 15-year versus 30-year. Someone who's deciding between the two outside of the interest rate, is there any difference in the two programs? Like why would someone choose a 15 versus having a 30 and putting a little bit extra towards principal?
Because typically 15-year loans have slightly better interest rates.
Okay.
And so that's the main reason you'd pick a 15. And some people aren't disciplined to pay their 30 like a 15, so they want to be forced to do it every single month. And so for those people, 15 years is a great option. They want a little lower interest rate. They've bought a little bit below their means, so the payment isn't going to kill them, and then they can pay that off faster. So if you're looking to retire in 15 years, that's a great way to plan to lower your expenses in retirement.
Yeah. All right. Cool. Well, that's all the questions I had. I appreciate the insights.
Great. Thanks, Nate. And for everyone who's watching, if you're a subscriber, great. If you're not, hit the subscribe button, like, share, do all those things. And if you're looking to get your mortgage locked in, give us a ring. We'll talk to you soon. That's all I got.